All right. Here we are again. It's Tuesday morning. Tuesdays are exciting. I thought we'd start off with the daily chart. First of all, let's take a look and see what the market's been doing over the last little bit. Hope you guys are all out there and happy and ready to go. Rocking and rolling with our track and trade software. Up in the upper left-hand corner, we have the S&P 500. Up in the upper right-hand corner, we have the Dow. This is the daily chart. All right, so these are the daily charts. You'll notice that I have them set up with an indicator called the Bulls and Bears. The Bulls and Bears is a proprietary indicator. It's actually my proprietary indicator. We wrote it here at Track and Trade, Gecko Software, and this indicator is based on Fibonacci and Elliott wave, and what it does is it kind of tells us whether the market's neutral, bullish, or bearish. And as you can see in these examples, down in the bottom left-hand corner, we have the Russell 2000. In the bottom right corner, we have the NASDAQ 100. And they're all neutral. They're all kind of neutral. So neutral means not great, but it also doesn't mean bad. It just means that the market's not got a lot of decision in one direction or the other. Right now, we're looking at neutral markets. So the market's come down off this previous high. And if you have my book, okay, just give you a shameless plug here. If you have my book, it's called The Stock Market Playbook of Strategies. You can get it on Amazon. Just go and search Lan H. Turner and you can pick up this book. It's 280 pages of how to trade, 280 pages, but it's really important stuff. It's got all the probabilities of what the different patterns are and what the markets are. And we talk about Elliott wave and Fibonacci. There's all kinds of stuff about investing in the stock market, but mostly it's tailored towards day trading type of stuff. But the most important thing that's in there is the Elliott wave and the accumulation distribution models. And so in there we have the probabilities table. It's kind of like I've said before, when you go and play blackjack, you have a probability card that tells you the probabilities, right? And you're allowed to bring those little probability card to the table with you and set them on the table, and you can look and say, oh, this is what she has, the dealer has, this is what I have, what's the probability of me winning? And you look at the little probability card and it tells you. Well, in that book, we have a probability table based on Fibonacci and Elliott wave. And it has the Fibonacci calculations and the Elliott wave calculations, and it tells you what the probabilities are. So if you learn how to count and measure using Fibonacci and Elliott wave, you can look at the probabilities of whether the market's going to rise or fall. And it works on all time frames. We call it fractal, which means that it works on small time frames, large time frames, daily time frames, 1 minute time frames. It doesn't matter. And because Elliott waves move in patterns, markets move in waves, generally one up for every down. We get a little wacky once in a while and it breaks that rule, but for the most part we have one up for every down, and then those waves are counted. We count the waves, we measure the waves, and then it tells us the probabilities, and that's in that book, and it's really good. I pulled a piece of information out of that book, and I'm going to go into that here in today's class, and we'll go over that a little bit, show you what we're trading. But market's about ready to open, so we need to get over to the 1 minute chart so we can watch that, because we like to watch the 1 minute chart on the open. So here's our 1 minute chart. Everything's getting ready. You can see this market's come falling down on the pre-market session, just really cascading down. We got this nice little crossover of the ATR, of the average true range. The price bars have turned green on the Heikin-Ashi bars. Notice we're using Heikin-Ashi. Again, we've got the same thing over here on the Dow. Look at how that thing turned right here just before the open. And if I turn Heikin-Ashi off, this is what most everybody's looking at, else is looking at. This is how their charts look. Of course, I don't know if they have the ATR on there, but this is what most charts look like. This is a typical chart, but we use Heikin-Ashi. Heikin-Ashi is still a Japanese style candlestick, and it tells us the average true range with the little yellow dots, and then the Heikin-Ashi has the Heikin-Ashi smoothing component. So here's actually our little buy signal right here on the Russell, right here pre-market. You can see the market started, that's the open right there. So that was a little buy signal right there that failed on us. Now that's one of the reasons why I don't trade the open, is because when the open comes in, man, the market goes crazy. And even though that was a buy signal, because the market rallied, right? We have the Russell 2000 tells us 1 minute chart is rising, and we go up into a rising market. The ATR is rising. We get a little pullback with the two red bars, and then another green bar is a buy signal anticipating an ABC continuation of the pattern. As soon as the market opened, bam, that thing immediately failed. So That's why I don't like the open. The open is very unpredictable. A lot of times you look back in time and you're like, oh, wow, you should have just bought right on that crossover just before the open, and it market just took off and ran and never came back. And that's true. It does that quite often, but it does this quite often too. And the problem is that you get caught in this and it rips your wheels off, and then you feel sick for the rest of the day. Of course, if you catch one, it's like fishing for sharks. If you catch one, you're happy you caught one, but are you really? Are you really happy you caught one? Scared the living crap out of you, right? This is a scary time to trade. So, for beginner traders, which is what I'm going to assume most of us in this class are, most of you watching this video are going to be beginners learning how to trade. I would recommend you avoid the opening bell. Now, we're here watching the opening bell because it's the morning session, and the morning session gives us the most opportunities with the highest degree of opportunity, or the volatility that's going to move the market in our favor far enough, but not right at the open. Now, we're in the futures market. We're not in the stock market. Here, I better pull up a little bit of information here for you, and we'll run a banner across the bottom to give you a little bit more information. We're trading in Chicago, okay, through the Chicago Mercantile Exchange. This is not the New York Stock Exchange, even though these are stocks, okay? These indexes are actually traded over in the futures market. So the comparable over in the stock market, for example, if you wanted to trade the S&P 500, you'd be trading something like the SPY. All right, that would be an ETF of the S&P 500. So this is the Dow up in the upper right hand corner. So over in the stock market, that would be the DIA, which would be another ETF. The bottom right corner is the NASDAQ. And again, we're trading that in the futures market out of Chicago. There are no pattern day trading rules, so you don't need $25,000 to come and do this. You can open up an account with $5,000 and you can trade this. And this would be the SPY. Now, the Russell, this is the Russell 2000, the 2000 small cap stocks. That's what the Russell 2000 is. And it is, I think it's TL, no, I can't remember. Can't remember the ETF for the Russell 2000. I have to go look it up, but you can go look it up. There's an ETF for the Russell 2000 as well, and I can't remember the symbol right now off the top of my head. But we've got the SPY, the DIA, and the QQQs, and that's what we're trading. Only we're trading the futures version of those, and so over in the futures market. And again, no pattern day trading rules, and we are trading on leveraged accounts. So we don't need to open our account with $5,000. And for example, let's come up here and look at the key. This is the Dow, and if I come into the Dow and we look at the key, to put on one contract with the Dow, okay, because we don't trade shares over here in the futures market, we trade contracts. One contract represents a certain quantity of shares. And in this case, the initial margin or the expiration margin, actually what we're going to be trading is, because we're day traders, we're going to be out by the end of the day, is the day margin. So the day margin currently right now is right around $750. So to put on one contract is $750. Of course, you put the contract on and then you take it off, they give you your 750 back plus whatever profit or loss you have. So let's take a dollar calculator and run that across this dollar sign, this bar right here. So that bar on the Dow, that's a $175 bar. So that bar has moved $175. How much money would you have had to put into the market to make that 175 had you caught it at the bottom and sold it at the top of that one price bar? You would have had to put in $750. So you put up $750, the market moves that far, you make $175. So it's significantly different, and way different than trading over in the stock market. To make that kind of money in the stock market, you'd had to put into something like, I don't know, $17,000 or something to make that kind of money in that kind of a move, rather than over here, we do it with $750. That's why you don't need a $50,000 account or a $25,000 account to trade. You can trade with a $5,000 account because you only need to put up for each contract $750. You put up $750 and the market moves that far, you made $175, and there's no pattern day trading rules. All right. Look at the markets go. They're going crazy. All right. So we're looking for our opportunity to get into this market. We're going to settle this thing down a little bit. Let's look at that. That Russell right there is really starting to run. That last bar on the Russell, $165 bar. That's a $165 bar. That's how much money you'd have made. And if we look at the key over here, how much would you have had to put in day margin? Oh, it's not listed right here, right now. It's not listed, but I bet you it's about the same, about 750, maybe $1,000, $750 probably again for the Russell. I'll look into why the day margin's not listed over there, but they're not posting that right now. So we've got boy, these markets really coming down. Look at this. This is a beautiful little setup for us right here. We have this first little rally. It came up, we got the first bar back, and then it turned and started to rally once again. That's our that's our system. That's the one we like to trade. Here it is again. So we had the first rally up. So it came in. We had the first rally up, and then we had the little pullback, the red bar, breaking of the red bar right there. That's our buy signal. The only reason that it was hard to take right now is because it's on this really wild and crazy opening bail. So that's exactly what we're looking for. Now here's another one right here, but notice the indecision. See the topping and bottoming tails in here? We had bottom tails, no bottom tails. That's good. We like to see 3 or 4 no bottom tails. They only got 2 here. We got a clearing bar. I call this a clearing bar because it has big topping tail, big bottoming tail, went beyond the upper bars of the previous bars, went beyond the bottom bars of the previous bars, took out all the limits and all the stops above, took out all the limits and stops below. That's why I call it clearing. It cleared out all the table. And then the very next bar is the one that generally decides the determines the trend direction. Because if it clears out all the stops and limits above, clears out all the stops and limits below, and they're all gone, now we have a fresh sheet of paper, so to speak, and what is the next trend is what takes over. We have the bulls and the bears, right? This is a game that we're playing between bulls and the bears. So who took over in this example? We had a clearing bar, big long bar, topping tails, bottoming tails. The next bar was a bullish bar that had no bottoming tail. So that's a bullish arrow, indication that the trend is probably going to be bullish. So that took off with two more bars. And then we had the little pullback bar, which was a little clearing bar, indecision, another little clearing bar, indecision. This is a buy signal right here as we're breaking above this signal right here. Okay, that's a buy signal. So as it breaks above that little red and that little clearing bar right there after a rally, it's not a very strong buy signal because it only had two bars. I would like to have seen 3 or 4 bars, but we got a much stronger one here on the Dow. And we got a nice, but that was pre-market. So we have to remember, we have to take that into consideration. This is all pre-market stuff that we're looking at here. So in hindsight, you're like, oh, that looks great. That looks great, Land. Why aren't you in that market? No, 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 no. Wait, hold on. Hold your horses. If you want to jump into this fray and go fishing for sharks, you can. But just remember, when you catch that bugger, it's going to be a fun ride. All right. So this is a buy signal, and it was weak because this market here, these two little clearing bars, and I was looking for it to break and rally, and because it didn't, yeah, again, it's just a weak clearing bar. It weak. You want it to immediately go when it breaks that bar and go and go. The ones that break out and go are your best ones. Those are your best trades. So it's being a little weak right now here, a little indecisive on the Nasdaq. Now remember, these markets should all trend exactly the same. In fact, for the most part, they do. What happens is you'll get some of this action happening where they're going back and forth. That makes it hard to trade. They're supposed to trend all together, just like fish. All right, going in a school of fish, and what we're looking for is we're trying to fish for the fish. But what happens is you end up with one that becomes a leader, and he takes off first, and then the others follow. So what we want to do is we want to trade the lagger. We want to trade the one that's last to go. So if they all take off except for one and it's a little bit slow to go, that's the one we want to trade because he's probably going to go. He's probably not going to fall backwards, right? I mean, the chances of him going in the opposite direction of all the other markets, if he's the lagger, pretty slim. So that's what we like. We like to put the probabilities in our favor. Now look right here, we've got the Dow is falling. Okay, see the Dow falling? And we've got the Nasdaq rallying. So that's not good. Those two should do the same thing. And if they're going in opposite directions, that's indecision. And we be very careful when you see that. Okay, so this stupid NASDAQ is finally looking like it wants to break a lot higher across this little channel that it created where we got this first pullback. Now it's looking like it's trying to break higher, but the Dow is falling. Okay, now the Dow wants to come in. Now we're getting another little ABC up here on the Dow. So watch this Dow. The Dow is coming in, and what we're looking for here and what we're watching for is this next rally. So this is the first rally up. Oh, I got to draw that in there better. So this is our first rally on the Dow. So we're going to draw, let's see, from here to here. So that's our first rally. Now we're getting the pullback, right? And then we would look for the next rally. Now, of course, this could be a reversal. So it could just turn and fall right back down without turning and rallying and going up and making another rally. But look over here. We got a little bit of insight from the S&P. The S&P pulled back, made the red bar, got a clearing bar, and then started to rally once again. Now it's trying to break above the previous high, and that's what we're waiting for. Looking for it to break above the previous high, and it failed. So it failed to break above the previous high. That means we should probably watch down here for these other markets to fail too. Okay. So that means look at the Dow. The Dow is starting to fall. And the NASDAQ is it's looking at showing strength here to the upside on the NASDAQ. But it's slow, and it's coming out of this ugly little sideways thing that we had going here. Where's my little sideways thing? So we had this little sideways market right here. And so it broke out the top of that, and it's trying to show strength. It's got flat bottom bars. See that? Flat bottom bars. But now this one is lower, but that's good. Sometimes that's what we're looking for. We want a lower high right in here, and that would give us an opportunity to look for the next rally up. But the problem we've got is we've got divergence between the Dow and the NASDAQ. Now remember, most of the stocks that are in the Dow are also in the NASDAQ. Okay, or vice versa. And then most of the stocks that are in the S&P 500 are also in the NASDAQ, also in the Dow. So there's a lot of crossover there. And so if we got one going the opposite direction, but the small caps, these stocks that are in the S&P, the Dow, and the NASDAQ are not in the Russell. So the Russell acts independent sometimes. And look at it run. It's really making a run. And now you look at it and you're like, well, Lan, why didn't you just get into the Russell on the open? Why didn't you? Because it's dangerous. we're not danger here. We're careful. All right. So this morning bell is a real dangerous time where you're going to go in and swim with the sharks. And the guys that are trading this opening bell, they're sharks. You have to be careful. They want to take your money. That's why they're there, because they want to catch guys like, us newbies. Not that I'm a newbie. I've been doing this for almost 40 years, but my students are newbies, and I'm trying to warn you, be careful around this opening bell. It looks great in hindsight, but it's dangerous. All right. It's shark infested waters. And all we want to do is catch little trout. All right. We're trout fishermen. We're not shark fishermen. We've got to be careful around these shark infested waters. We'll get our shot. There's lots of time. There's 6 more hours of trading. 6 hours to find just the right setup that works for us. We don't need to come and swim with the sharks right off the bat. All right. So we're going to just be careful. We're going to be very cautious and give you a little bit of information about me. Lan Turner is my name. Former instructor at the Chicago Mercantile Exchange and Board of Trades Education Center. I had the good fortune of teaching there. And it was actually more of an education for me than it was me teaching. Even though I was a teacher, I got to sit at the feet of some of the greatest traders that this country has ever seen and learn from them while I was teaching. I was there at a time where they were trying to close down a lot of the action on the floor of the pits. And I was brought in to help teach people how to move from the pits into the electronic trading, because electronic trading was becoming more popular, and those guys that were on the pits needed to learn how to move from the pits to the computers. And so my job was to come in and help guys learn how to trade on computers. And oh, look at this beautiful little setup right here. We got a nice little setup right here on the Dow. We're getting the same little setup over there on the S&P. Not quite so pretty on the S&P, but see that little break right there? Now this could be to the downside, because we have, look what we've got going here. Okay. See this arrow right here? That's crossing of course, it's crossing the VWAP too, volume weighted average price, but it's also crossing the average true range. Now this could be one of two directions, right? If we draw a trend line down the top like this is a green bar. It could be a rally. It could be a continuation of this uptrend. So we could come in here and say, well, I think this market's going to, let's just go off this first leg, the second leg. I'm going to think it's turn and rally and it's going to go up again, break this previous high and continue to rally, right? Or it could be a signal that we're going to go short once again and we're just getting a little ABC to the downside. So it could come this way, down here, pull down, go up, didn't break the ATR, and that's an indication that we should see this market fall. So if that's the case, we'd want to take a first break to the downside and watch this market continue to fall. The problem is it's at a neutral zone right here, trading around the VWAP. So at the VWAP, that's all neutral. So it's not making any decision. But if we wanted to trade, we come in here and we could trail up just like this. Now this is a trailing stop. It's a stop for entry. If the market continues to rally and go up, we won't get in. But if the market turns and starts to fall once again and breaks new lows, well, we get filled. Okay, we just got filled. All right, and we have a limit order down here. We can set that down here at whatever price we want. I'm going to delete that limit order for now. And then we can add in a stop order, OCOs, and we can put in here. And our goal is to make $500. So on this first run up here, we're not going to make $500 on one run. We'll just put it down here, testing the new lows right around 250. We'll just put that right in there. And we'll say if the market comes down there, we'll take 250 out of the market. More likely we could make, in one trade, we could make $500 if we were on the NASDAQ. It's a much bigger market. But this thing's being stupid. It's not coming down immediately. We want it to come down immediately and go in our favor. Otherwise, it looks like it might go up. So if that's the case, we can we're just going to get out. I was going to reverse my position and go long, but I was too slow to do that. Now it's being stupid again. So we're down $75 on that attempt. Okay, we cast our line in the water, and they took our bait. And they're going to come down. They're going to try it again. Should we try it again? We can try it again. Okay, we'll take another short. We'll try it again. We'll put this limit down here to take profits if it comes down and tests this previous low in here. Okay, we need to try it again. The problem is, let's actually calculate that. We're down $75. Now I'm going to show you at OCO. I like to recover my losses. Now I know a lot of traders don't want to do that. They're like, oh, don't play recover losses. Just trade the trend. That's fine when you get a little bit more experience. But I want to teach you, when you first start trading, it's a good thing to recover losses. So you put your limit at where you lost your money. That way it brings you back to zero. You can start fresh again. So your first trade, just try to recover your losses. So we're going to come in here and see if this market won't come down and at least give us back the money that we lost. It's interesting. See how far the distance is from this red line to the buy limit line? Looks a lot farther than how far the market moved for us to lose that money, doesn't it? Some reason, I don't know if it's an optical illusion or what, but that's how far against us that market moved when we got our stop order. But now it's coming back against us again. It's being stupid again. If it goes to zero, I'm going to get out, because it needs to go just decisively in our favor. If it doesn't move decisively in our favor, we don't want to add to our losses. The other one never did even move decisively in our favor, so we never even got the opportunity. Come on, drop, you silly market. We'd have been better off over there on the S&P, wouldn't we? So if this pulls back and I get back to basically break even, I'm just going to pull it off and we'll try again later. I'm not going to quite make it. Come on, you need to fall a little bit farther. Come on, there we go. Come on, one more step. One more, come on. Oh, you dirty dog. It's almost there for us. If it backs off too much, we'll just take it at... Come on, one more push. You can get down there. Come on, one more push. One more push down. It's being slow and lazy suddenly. Bulls and bears are pushing against each other. The bulls keep pushing it higher. The bears keep trying to push it lower. The bulls are like, this is a great place to buy. This is a great place to buy. Look how low it is. Oh my gosh, I'm going to buy, buy, buy. And the bears are like, no, no, sell, sell, sell. Push it lower. Oh, there's green. It's going green on the ticker. That's time and sales up there in the upper right-hand corner, that little tiny chart. We're charting the time and sales. So when it starts to rally, you can see that the lots of green on the tape is what they call that. So we see it as a chart in track and trade. It's a little tiny chart. That's your tape up there in the upper right-hand corner. Come on, push down there. I think we're going to get a failure here. It doesn't look like it wants to go down. Looks like we've seen as much down as it wants to go. We're going to take it off right there. We're not going to lose any more. You dirty dog. We tried to get our money back. Didn't quite go. Now it's getting indecision. It's going back up. It's breaking all the stops from the trailing stops. Those 3 bars. Now watch it turn and cascade back down. There's a clearing bar. Okay, that's a bar of indecision. So we have topping tail, bottoming tail. Now we have to wait for another opportunity because this one here just got broken in half. So the next bar will generally determine the next trends. But it didn't quite clear. So we got a clearing bar to the upside where it went and took out all the trailing stops, but it didn't clear to the downside. Okay, it didn't clear this previous bar's low. So it's just an ugly indecision bar with went back and stopped everybody out. So now it'll probably continue to fall. But look at the NASDAQ. NASDAQ's starting to rally. So now we got divergence again between the Dow and the NASDAQ. So the NASDAQ wants to go up while the Dow wants to go down. The S&P wants to go up. It's trying to go up. It's got green bars over here, but it's a lot of indecision. The Russell's just going sideways. This is what I call a price correction. So a price correction is where the market makes a nice, beautiful trend like this, but then it doesn't continue the trend either up or down. It doesn't turn and reverse, and it doesn't come and make a little pullback and then continue the rally in a nice, another big trend. It just starts to go sideways and dies. I call that a price correction because the price moved from this price right here, right, which is going nowhere. It's kind of sideways, a nice rally, and then another sideways. It's just a price correction. It's like, okay, let's buy a bunch. Do you want to get rid of them? No, I'll just hang on to them. You want more? No, I don't want any more. And so the market just goes sideways after a price correction. And that makes it really hard to trade because you get excited and you're jumping in. You're like, hey, market's on a run. Let's get in. And so you think, okay, we'll take the next leg up, A, B, C, D. And then it doesn't go. And then you get your bait taken. So this is fishing. These are our 3, 4 fishing holes. And we're just going to go fishing. All right. Or you can think of it like football. This is the Bulls and the Bears. Bulls playing against the Bears. 2 football teams. And then what we've got is we got the Bulls have the ball and they want to take it long. You got the Bears that are on defense. They want to push it short. If the market starts to go short, we got defense. We got the Bears take the ball and start to push it lower. The Bulls take the ball and start to push it longer. And it's just a big football game. All right. Let's come in here and see what's going on. Good morning. Matt Baker says hello. Hey, Matt. Matt was picked up Pit News magazine yesterday, and he actually is a real person. I went and looked, you guys who said he wasn't a real person. So B. Taylor, welcome. Glad to see you in the class again. I got something for you guys. I made something yesterday, and let's pull this up. This is a little diagram of what we're looking for. All right, while the market's being a little slow, let me see if I can turn this banner off. Let me get rid of my picture here out of the corner. So this is the pattern that we're looking for. This is the primary pattern. Now look, we're getting it right here on the Dow over here on the other market. So we're going to talk about this. So this is the pattern that we're looking for. Okay, it's called an ABCD pattern. You get them to the upside, you get them to the downside. But what we're looking for is we're looking lots of flat bottom bars on the way up, at least 4. I like 1, 2, 3, 4 is good. And then we get 2 red bars pulling back. And we don't want them to go up and break. We don't want it to come back far enough to break the average true range. Those two red bars on the way back should not uh, break the average true range. And then we want to see it break a previous high. Once it breaks a previous high, we want to see it rip and start to go higher once again. And that's the A, B, C, D. We're not going to trade the A, B. We're going to trade the C to D. Same thing on the bearish side. We're not going to trade the A to B. We're going to trade the C to D. All right. We want the market to prove to us that it's starting to trend first. Then we want to see a hesitation in the trend. Then we want to see the next leg, whether it's up or down. All right. I have another one here for you. This is the other one that we look for. We look for a rally bar. These are called thrust bars. So we get a nice big long bar, then we get a small little pullback bar, and then another thrust bar afterwards. Sometimes you'll get a little pattern like this with two bars. Or big thrust bar, a little pullback, and then a break above the previous thrust bar and continue higher. Same thing on the downside. Now this isn't as high a probability as the ABCD pattern. ABCD pattern is actually a little bit better than this one. And then of course this is the next one, which is a little bit more not quite as high a probability because the market's had more neutral time. So it starts to rally, it goes up, creates a high, pulls back down, creates a support, goes up and tries to break the previous high and fails. We might have taken a long position right there, right? And that would have got us stopped out as it turns and falls once again. And then we can try again on the second attempt to go higher. And then if the market pulls back, test the support level, you can add in there if you're aggressive, or you can buy on a break above that red bar, and away we go once again. So that is the patterns that we're looking for. We don't need to go beyond that. There's one more that we can go into, which is the flat top and flat bottom. I call them the flat top ninja and the flat bottom girls. Okay, and it's based on a flat market. It's going sideways, like we're seeing down here on the Russell. So if I flip back over and show you, this is the Russell. See the Russell? We got a flat top ninja right here. It's getting ready to go. And usually what happens, if we go back to the image, is usually if we have a flat across the top, the little yellow bars are across the top, the market takes off and goes up. If the bars, the little yellow dots are flat across the bottom, the market usually falls and comes down. See that? So if we go over and look at the Russell, what is the Russell? What is the Russell? The Russell is a flat top ninja. It looks like it wants to fall and come back down, right? From that last diagram, this would be a down signal. But look at what the Dow is doing and the NASDAQ. So the NASDAQ actually took off like a rocket ship. It's taken off, and so has the S&P taken off. The Russell, the Dow, it went too, but it's not quite as aggressive as the S&P and the NASDAQ coming out of this little pullback, this indecision area. So we have this little pattern right here. So this little pattern right here on the 1 minute chart. Okay, see this little pattern right here on the 1 minute chart? Let's get rid of this drawing tool. I'm going to draw a circle around it right there. See this pattern on the 1 minute chart? See that? If I take that and look at, show you again, it's this pattern right. Let me see, where's my, that's that pattern right there, isn't it? Let me get rid of this so you can see. That pattern right there, see that? It's that first pattern right there. So we got the first rally to the top, it failed the second one, and it went on the third one. Okay, so go back and I'm going to look at the NASDAQ once again. Look at this pattern right here, this bullish pattern. Now we're going to go to the NASDAQ. Now look at that pattern. It's right there. That's the exact pattern we just drew a picture of. Okay, we got the first rally up, came down. It failed to the first drive, came back down. And when we tried the next drive, that one was the buy signal right across that red bar right there, which actually happened to be the VWAP. And that's where that market took off and started to go. And all the flat bottoms, see all the flat bottoms? So if we'd have been paying attention, we could have taken that there, and we didn't. That would have been a nice trade, and we'd have been done for the day. We'd have easily made 500 bucks on that one. Plus recovered all of our losses that were down right now. Although the problem is that we've got a flat bottom ninja over here on the Russell. Now, it doesn't mean it has to fall. It just means that if it does fall, that's where you'd take a short position. It can still rally out of this narrow sideways channel. Okay, because we get kind of that same ugly little pattern. This is the ugly one. This is the high. It tried again here, and now it's breaking above and trying to go long once again. Now, we're getting the pullback on the Dow. Okay, so we're getting the Dow. I like to trade the Dow because it's a little bit smaller market. And when you're wrong, it doesn't rip your wheels off as badly as the Nasdaq. Of course, when you're right on the Nasdaq, you make a lot more money. Yesterday was a good day. We traded the Nasdaq, and we made our $500 in split second. So look at the Russell. It's taken off. It's breaking above that previous high. Now it's testing this previous high right here. So it's testing that high right there. Right now it's bouncing off of it, and you'll notice that it's got to break through that and hold above it. Okay, so it's got to hold above it if it's going to stay up there and go. The problem is we got divergence, right? Now the S&P and the Nasdaq are falling. Look, the Dow's not falling. The Dow, look how late the Dow is to follow the S&P and the Russell. So we could take a short position on the Dow right now in anticipation that it's going to follow the Russell and the Nasdaq down, unless it wants to diverge and start to follow the Russell up. That's kind of an odd thing. It shouldn't do. Okay, so we're getting this little pullback ABC pattern. It's kind of a scary one because it's so big. It's so big. Lots of reasons. Because what we do is we put our stop behind the price bar that we get in on. So that would be a $380 risk. That's just a big market right there. Of course, if we're right and it takes off and goes once again, oh, now it just broke the average true range. It's no longer bullish. It's now bearish. Coming down, touching the VWAP. Remember, the VWAP is kind of like a rubber band. All right, think about the VWAP as a rubber band. You ever played that game where you got a paddle and a rubber band hooked to a ball, and you bang, 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 bang? That's what the VWAP is. The VWAP is the rubber band, and the market is the ball, and the VWAP keeps pulling the ball back to the VWAP. Okay, so the VWAP, if the market swings high above the VWAP wants to pull it back down to the VWAP. If the market swings way down below the VWAP, it wants to pull it back up to the VWAP. So VWAP is kind of, think of VWAP as neutral, and the market swings over and above and back and forth across VWAP. Now, if it can get up, if we have a strong market and it can get up above VWAP and we're bullish and the market sits there and higher highs and higher lows and stays above the VWAP, that's a great day because all you have to do is keep buying the dips. And then the market goes up again, buy the dip, goes up again, buy the dip, goes up again. That's a great day. But when it sits there and swings back and forth across the VWAP, that's a neutral, indecisive day. So we're getting a lot of indecision right here. So you can see that on the Russell. It made the price correction. It went up. It broke that little trend right there above the second high. It went up and tested the previous high and failed. Now, usually when it fails the first time to test the previous high, it try and go up and it'll try and test it one more time. And oftentimes it's that second test that'll break and go through. So we'll have to wait and see. But you can see volume came in and then volume fell back down. So now we got the little ABC, but we're bearish. So now that turns us to the downside. So is it going to go up, come back way too far, broke the ATR to the downside? Now it's telling us everything is bearish, and then going to go back up and continue the ABC to the upside. This is what's difficult about trading. You don't know which direction it's going to go. Okay, it's telling us that it's bearish, but it's giving us the little ABC, and it wants to rally and go higher. Is it going to continue to rally and go up and break the ATR and flip the arrow, and the arrow is going to say now we're bullish once again? Or is this just a micro pullback, a little flag formation, we call it, flagging to the downside again? Or is it just going to stay neutral? Because we could take a short position off of here. Let's drop one in there. If it drops, this would be because we got the down arrow, right? So we got 1, 2, 3 bars down. We only got 2, so it's really weak to the downside. So this is not really, I'm not really happy with it. But the Dow is falling, the S&P is falling, the Nasdaq is rising. So I want to see the Nasdaq fall with the Dow on this little micro pullback. Here we go. I'm going to get rid of this one because it doesn't have the calculator on it, and add a calculator in. So we could just try to recover our $65. Oh, look at this market. It's pulling right back immediately. Our $65 would be a recovery right around there. But this market could fall further than that. That's only $55. And then we'd feel bad we got out with a recovery. But I think at this point where this market's being so weak, I think we should take a recovery at the VWAP. Oh, came down and gave us our money back and then started to back off again. What a lousy market. Look at that. It should have gone down, should have kept going. Now we got a clearing bar. What a rotten market. Come on, you guys. Let's go over and look at the news. Let's go look at the news. This is the economic calendar. So the economic calendar right now, if we bring that up, I can show you. I think it's coming up. I think you can see that. Can you see that? Here's what it is. This is the one yeah, it's working. All right. Here's what I want to bring over to your attention. Okay, see this? This is Tuesday, September 12th. 4 a.m. we had a news report. 8:30 a.m. we had a news report. And at 10 o'clock we have the WASD. 8:30 we have the New York Fed Treasury purchase. That's not going to move the market much for us. We don't really care about that. It might move it a little bit, but it's not probably going to do much. It's the ones that are red that are really going to move the market. But the WASD report, that's an important report for corn, wheat, beans, soybeans. We are in the futures market, but we're trading the indexes. So we could switch over at 10 o'clock and go look at the grains, because that's what that's going to affect. And in fact, here's the WASD. What is the WASD? People say, oh, what's WASD? What's a WASD report? That's the World Agricultural Supply and Demand Estimate. It's a monthly report prepared by the World Agricultural Outlook Board of the United States Department of Agriculture. The report provides annual forecasts for supply and use of U.S. and world wheat, rice, coarse grains, oil seeds, and cotton, as well as U.S. supply and use of sugar, meat, poultry, eggs, and milk, and Mexico's supply and use of sugar. The report is prepared by the Interagency Commodity Estimated Committee, which includes analysis from USDA agencies who compile and interpret information from USDA and other domestic and foreign sources to produce the report. The WASD report is prepared under tight security. It is designated a lockup area of USDA South building to ensure that the market sensitivity projections are released simultaneously to all end users and not prematurely to anyone. The report is widely yeah, okay. The report is widely used by farmers, traders, processors, and other stakeholders in the agricultural industry to make informed decisions. So where we are in the futures market, this is a very important market to move the traditional commodities, and that's going to come out at 10 o'clock. So be mindful of that, and you can come over and watch those reports. So let's go see what we missed while we were goofing off looking at the reports. Good thing we didn't stay in that NASDAQ. The NASDAQ didn't go anywhere. We took a short position off of those green bars, a break of those green bars, only to get another clearing bar. Oh, but look up here on the Dow. We traded the Dow first, and then we were like, well, the Dow's not being very strong, and we took a small loss on the Dow. So then we're like, well, we'll trade the NASDAQ, and then the NASDAQ didn't do very well either. And then the Dow was the one that started. This Murphy's Law. Which one are you going to trade? Which one are you going to be the one that takes the position on? Murphy's Law says that you're going to take the wrong one. So anyway, this market's just being ugly and stupid right now on the NASDAQ. It's being a little bit nicer up there on the Dow, so let's see what the Dow's going to do. This is a little pullback on the Dow, but the market's already kind of, see that little flag right there? We call that a flag formation. And the reason we call that a flag formation is because we have this peak bar come down, and then we have higher lows, but we have lower highs and lower highs. So this becomes what we call a flag. So we say the market is flagging. All right. So the market is flagging. It's in the process of creating a flag. So we would look for a breakout of the flag in this case, to the downside. The reason we look for the downside is because we're in a downtrend. So the market is coming down, it flags, and then we would expect a continuation of the downtrend. So that's what we would look for. We'd look for a breakout. Now, if it broke out the top of the flag, that would be a reversal signal, and we would wait for the market to rally up, give us another flag, to the upside, and that would be our buy signal to the upside. We don't break the flat. We don't buy a break out to the long side of a flag in a downtrend. That's generally not what we do. We wait for it to make the reversal, make a flag off the long position, and then take the long trend out. Okay, so we don't generally want to take this break to the upside out of a flag. So this flag came down, tested this low, and failed. Okay, which is why I didn't take it short, because I was worried it was going to do that. So it come down, tested this low, failed, started to look like it wants to rally. Now you're like, jump in, land, go long, go long, go long. No, be cautious, be careful. We want to prove that we're making a reversal first. We don't want to just take every little reversal, because that's where you get in trouble. Okay, we have to be careful. We have to be cautious. We want to prove that the market's going to rally first. So we're going to look for 3-4 bars up. So we got our clearing bar. Didn't clear the bottom side, but we already got a test of the bottom side. So we want to make sure that this thing goes with nice. I want to see 3, maybe 4 flat bottom green bars up here, and then I want to see a couple little red bars. That's where we'll take our long position to the next run higher. All right, and that looks like to me it might be a little head and shoulders bottom formation, which would be, this would be your left shoulder, your neckline. This would be your head. We're going to come up and look for the neckline, come down to look for that right shoulder, and that right shoulder is where we're going to look for that thing to take off and go to the moon. And if it doesn't, then we'll wait for another perfect setup, something like this, okay, is what we're looking for. So that thing, we want to see it come up. Don't flag right there. That's a really bad spot to start flagging. And a flag, of course, means higher lows and lower highs. If it flags after only 2 bars, that's bad. Bad news. We need it to break a previous high. There it did. Okay, that's good news. This is what we want to see. We want to see 4 flat bottom green bars. I want to see it break that neckline, go up, test that VWAP again. Let's see it go up there. I want to see 4 flat bottom green bars. And if we get those 4 flat bottom green bars and then 2 red bar pullbacks, we can take a long position to the next leg up. If we don't get it, we don't get it. I wouldn't be doing my job here if I wasn't telling you the platform we're on, right? My trading platform is Track and Trade Live Futures. You can get a free 14-day trial at trackandtrade.com. Come and join me. Go over, get your trial. Come over here, and I'll help you set it up. We'll set yours up like mine. This is using the Heikin-Ashi bars. Of course, we got other things we're looking at too over here. I've got multiple charts, but you can't see everything that I've got going. I've also got a 2-minute chart that I like to look at. So here's the 2-minute chart. 2-minute chart's a little bit cleaner. It gives us a little bit better idea of what's going on because it's not quite so noisy. And you can see we're just in a flat neutral time frame based on the bulls and bears. We talked about the bulls and bears earlier, where it's based on Fibonacci and Elliott wave and the probabilities, and then we count the waves. So that's what we're looking at here in the 2-minute chart. This is my long-term chart when I'm trading. The 1-minute chart is where we execute. The 2-minute chart is the trend that we're executing off of. So this is that pattern. Okay, look at this. Okay, see this pattern right here, this high, and then the next high, and then the break low right here on the S&P. See that? We're coming down here, but see this high, the first high, and then the attempt to cover the first high failed, and now this is our buy signal to the long side, looking for and anticipating this next market to rally up. That's this pattern right here. So if I throw that back up on the stage, that's that pattern. Let me get my face out of the way. That's that pattern. See that on the 2-minute chart, and it's the same thing we're seeing on the Dow on the Dow. So that's this pattern right here. It's a bullish pattern. So let's go back over to the charts. All right. So that's that pattern right there on the 2-minute chart that we're looking at on the S&P. But I'm going to go back now to the 1-minute chart. I'm just going to pull up the portfolio of 4 charts. Okay. Now we're getting that on the Dow, on the S&P. We're getting 1, 2, 3, 4 bars, 3 higher, 4 lower. That's perfect. That's just what we want to see. On the 2-minute chart, we're seeing that that pattern to the long side. This is getting me excited. All right. I'm getting excited. I want to see 2 bars pull back now. I would like to have seen that stay green first. I wanted to see 4 flat bottom bars. It's a little showing a little weakness, but we'll we'll try it. Excuse me, losing my voice. There we go. Oh, look how it came back and it broke that. Came back and broke that low right there. That's not good. We didn't want to see that. See how it broke that low right there? That was coming back and taking out the stops. And then it starts to rally. Now we need to see it come down. The problem is if it's too weak, I don't want it to break the ATR. No, don't do that. It broke the ATR and it's going to close below the ATR, which is going to flip this thing and go the other direction. Okay, so this was a bearish pattern, a bullish pattern to the upside, trying to break above this previous high, and it just broke bearish. So now we're still in a downtrend, this bearish downtrend. See this bearish downtrend? We're coming up. We just got this bearish trend coming here. I thought we were going to get this thing was going to turn and rally and come up and give us a nice big long uptrend here. And it looks like it wants to come back down to the bottom of the channel. Let's wait and see what happens. That might stay above it's just spiking that ATR. Okay, that's okay. Don't close below the ATR. Whatever you do, don't close below the ATR and reverse us to a bear market. We want to stay bullish right now. Let's get ready to trade. I'm going to come in here and edit this number 17. And I'm going to turn this off to 0. I want that set to 0, and I want that set to 0. Okay, here we go. All right, we're going to go long. All right, we're going to go long off of this pullback. Oh, it did break the ATR. This is a dangerous thing to be taking a long position right here, but I want to see this continuation. I want to see the bullish pattern break. I want to see it come up and break above this high right here. We're doing it on the Dow, which we probably ought to be doing it over on the S&P instead. What's it going to do? Come on, bulls. What a wimpy market. We might just get ourselves into a position and have it fail on us again. I'm not going to take a big risk here. We're just going to go one bar back. This is a reversal stop. So if it goes up and fails and turns and comes back down, we're going to take the short position, called a reversal stop. Notice that I'm selling 3 and I'm long 1. So it will reverse the position. It'll take off the long 1 and put us into the market with short 2. It's kind of a dangerous little trick, but it's one that works well if the market will move for us. If the market's weak and doesn't move, we need a breakout. We can't have it go sideways. That's bad. Sideways markets where we get our wheels ripped off, and we're getting lots of sideways markets here. This is not a good market. We probably shouldn't be trading. We're sitting aside, sit on our hands a little longer, but we'll take one more shot at it. If it doesn't work, we'll sit on our hands for till top of the hour, till 9 o'clock. I like to wait till the top of the hours, 9 o'clock, 10 o'clock, 11 o'clock, 12 o'clock. You're going to see that I don't know why, psychological somewhere, but it seems like at the top of the hour, we start getting action. All right. So the market, if it's weak, and it'll kind of be stupid for a while, and it's being stupid right now. It should have immediately just gone. It broke that high. It needs to just go. And if it looks back at all, we just want to get out. We just want a market that's got strength. The bulls are all jumping in, and we're going to the moon. Let's go. Let's go. Come on, whip that pony. And if it doesn't go, then we just get out. We don't want to take a loss. We don't want to sit in this thing and say, oh, well, it'll come back. I know it'll go up eventually, and sit through a huge drawdown. Don't do that. Once you get in, you get your signal, you get your break. If it doesn't immediately go in your favor and go, and it starts coming back and starts showing weakness, just get out. Unless you're going to do this stupid trick I'm doing right now, which is a reversal trade, which would then anticipate a cascading down of a falling out of the bottom if this rally fails, which it looks like it's going to fail because it went up, it broke that previous high. We should, come on. This is frustrating. Frustrating trading day. So it failed to break that high, failed to break above the ATR. It's just weak, 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 weak market. Come on, buddy. Come on, whip the pony. Whip him. Whip him. Spurs. We need some spurs. This is weakness. We should just exit. I'll hold on for a second. I don't want it to go negative on me, but and I'm not going to take the reversal. Oh, maybe we will. Let's just let's see what happens here. Maybe the reversal. Maybe the bears will push it. Come on, whip that pony to the downside now. Come on, baby. Come on, kick in the spurs. Now he's just coming back. We're just gonna get ourselves in trouble here. Come on, spank him. Come on. Come on, give him some oats. Come on. There we go. Back to break even. So I like to do that when, you have a little few rough trades and you get down a little bit. I like to take, now we can reset things. We can cool off. We can say, okay, we went to 8 o'clock, 8:30. We haven't made any money. We've taken what, 3, 4 trades. All we did is get back to break even. I like to get my self back to break even. I can breathe deep. I'm not down $100. I'm not feeling bad. This market is still going and you're like, oh, you should have stayed in. Yeah, well, how many times did we try to stay in and it didn't go in our favor, right? The last 2 times we did that, we tried to stay in, didn't take the money, and we ended up losing it, losing more. So I like to get back to break even. Now I'm back to zero. Now I can start to work again. I can wait for another setup. I can wait for another pattern. I can wait for another more volatile market, a little bit. I don't want to swim with the sharks in the morning bell, but I don't like this either. These are guppies and and goldfish. And now this is the guppy goldfish markets. This is really tough to trade into. We need something halfway in between. We don't want the sharks in the morning bell, and we also don't want the guppies and the goldfish in this type of a market. We need just some nice, 1 pound, 2 pound trout. We're trout fishermen. We don't want the little ones. We don't want the big ones. We want the ones that are just right. Papa bear, mama bear, and baby bear. We like mama bear. All right. We like mama bear markets. All right. So go get your track and trade software. Come and join me. And let's trade. It's fun. It's fun. We're having fun. All right. We're not going to take big risks in this class. If you want to take great big risks and make $1 million in 15 seconds, like some of these guys say they do, go watch another channel. That's not what I'm doing. I'm just trying to make $500 a day is my goal in this channel, and then you're done for the day. If you can make $500 a day, that's life changing for some people. $500 a day. If you added that to your bottom line every day, that'd be pretty nice. Not that we're going to make $500 every day. We have days where we have scratch trades and we don't make any money. Of course, I'll come back at 9 o'clock. I'll come back at 10 o'clock. I'll come back at 11 o'clock, and I'll watch for the opportunities. And it usually works out pretty good. Now look, the NASDAQ. We should have done it on the NASDAQ, right? Because it's still dropping. The Dow, it died on us. That's the market we were trading. It died on us. We got our money out of it. It died on us. Doesn't mean it's flagging right now, but it's an ugly little flag. We just need some news or something. All right, here's something else I want you to be aware of. Pit News Magazine, trusted source for intelligent trading intelligence, pitnews.com. I want you to go and subscribe to pitnews.com. Yesterday, I know that Matt's here with us, and Matt subscribed yesterday, got into the class. So I'm going to be working with Matt. Matt says that he really liked the article on the CMF. Good. I'm glad you liked it. The CMF is a great tool. It's the commodity. What was it? The chalk and money flow. And so what it does is it tells us when the market's, it's kind of the reversal of what we do. We as small speculators, we like to buy low and sell high. But the large speculators, the large hedge funds, and look at this. Oh my gosh. The NASDAQ dropping like a rock, and our stupid Dow, the one we were in, is hesitating. But it's getting ready to fall. Look at that. It's that little flag is paying off for somebody. Look at it go. But the big speculators, the large banks and hedge funds, they like to buy when we're selling, and they like to sell when we're buying. If we're buying in an uptrend, who's selling to us? It's the guys who bought in the downtrend, which is usually the big banks and hedge funds. And that's what the chalk and money flow teaches us. And it's a great tool, especially when you're trading, like for investing in the stock market and stuff. It kind of helps you know better when to be buying and selling in the stock market on longer term investments. It's a great tool for that. And glad you liked the article, Matt. Hope you liked Pit News Magazine, all the rest of them as well. There's some great articles in there. Did you have a chance to listen to the did you have a chance to listen to the articles, some of the others? There's audio on almost all the articles. I did a video for mine, but the others had audio, and so that was really nice. The little signpost pointing the way says there is a 4-hour supply zone just above the DJI. I would not want to be going long. Yep, not yet, Matt. There's a really good article in there by Aiden Gray that I really like. So go watch that one in the Pit News magazine. Look, you can get Pit News an entire year for this amazing magazine, which has audio. It's like a podcast magazine for $1 for the entire year. So everybody jump over, get that, support the channel. That would be nice. And you're going to love, love, love Pit News Magazine. So jump over there and do that. Oh, and just quickly, did you get your covered calls book too, Matt? Because if you sign up for Pit News Magazine, you get this free covered calls, how to trade for income, solving the 5 pitfalls. So for $1, you get the entire year subscription, plus you get the solving the 5 pitfalls of covered calls as an additional bonus. That's a great little book too. I wrote that one. So get that for free when you sign up for Pit News Magazine for $1. If you don't have $1 to be learning all you can about different trading strategies, that's what Pit News Magazine is all about. It's all about trading strategies. Look at this. Look at the NASDAQ. Oh my gosh, look at the NASDAQ. Oh my gosh. Look at the Russell. And then the Dow, wimpy Dow, the one we were trading. Good thing we got out when we did. We should have been trading the NASDAQ, right? All right, guys, I tell you what, I'm going to come back at 9 o'clock. Not here. I'm going to let you guys go, but I want to, before I go, I always like to end with a little lesson. So we're going to look at our little lesson in here. So let's get rid of this, and let's get rid of this so you can see. Oh, let's see. How do I get rid of that? Oh, then how do I get rid of that? Let's get rid of that. There we go. Size matters. All right. Plan your trade and trade your plan. It's easy to trade 1 or 2 perfect setups with larger position size. Let's see, the question is, I guess it's asking, is it easier to trade 1 or 2 perfect setups with larger position size, or is it easier to make lots of trades with smaller position size? Don't trade out of your league, all right? This is why we don't want to trade the opening bell of some of these markets, because it's, that's where the sharks are. So don't trade with the sharks. When first starting out, only trade 1 or 2 perfect setups with the smallest position size. We oftentimes say, trade small, but trade a lot. Trade a lot, but trade small. And then you can grow into your pants. So don't bet the farm, grow into your pants. So you can start off by trading small, but trade a lot, trade all these little patterns, but trade small. So you can get used to it, get some experience, and make some small profits. And then you can scale up. All right. Start to scale back, find out which trades are the absolute best, which ones are working the best. And then you can come in and you can scale up. Okay. So you can put on bigger positions and take fewer trades. So that's the idea. Trade small, but trade a lot, or trade big and trade very, very seldom. So that's kind of the game that we're playing here. All right, one more look at the markets. That NASDAQ is falling out of bed. Look at that thing go. Holy cow. So there was a nice little flag right there. So there's a little flag. Here's another little flag right here. These are areas where you could enter into the market when it broke these previous lows. This is what we call it, flagging. So the market was flagging and then it dropped. Then it flagged and then it dropped. Okay. Flagged and dropped. Now we've got divergence between the Dow and the NASDAQ. So the Dow wants to rise in price, breaking the average true range, showing positive bullish trend, while the NASDAQ is still falling. So this is probably an indication that we're reaching the bottom of the NASDAQ trend. All right. Doesn't mean it has to stop there, but usually when the other markets start to rally, this one will slow and we'll start to look for it to reverse and start to come back up. Then we'll see how far the Dow rallied to see if this is just going to be another flag and another drop to an ABC down or what that's going to be. All right. All right, guys, we'll continue to watch. I'll probably come back around 9 o'clock, 10 o'clock, and I'll probably do a little bit more trading on my own to see if I can't make a little bit of money today. But I'm going to let these markets cool down, calm down a little bit, come back at 9, 10 o'clock, top of the hour. And we'll catch up with you. Hopefully you'll be here tomorrow and we'll do it again in the morning. All right, tomorrow morning we'll try again. All right, take care. We'll see you.